Today's meeting, let me comment briefly on recent developments in the banking sector. Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode, and will work to prevent events like these from happening again. As a first step in that process, last week we released Vice Chair for Supervision Barr's review of the Federal Reserve's supervision and regulation of Silicon Valley Bank. The review's findings underscore the need to address our rules and supervisory practices to make for a stronger and more resilient banking system, and I'm confident that we will do so. From the perspective of monetary policy, our focus remains squarely on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by a quarter percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 3 months of the year, job gains averaged 345,000 jobs per month. The unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are coming back into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 4.2%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 5 to 5.25%. And we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We are seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In addition, the economy is likely to face further headwinds from tighter credit conditions. Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses. In turn, these tighter credit conditions are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will make that determination meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we are prepared to do more if greater monetary policy restraint is warranted. We remain committed to bringing inflation back down to our 2% goal and to keep our longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Gina.
Hi, Gina Smilik, New York Times. Thanks for taking our questions. I wonder if you could tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June. And I also wonder if the Fed staff has in any way revised their forecast for a mild recession from the March minutes. And if so, what a recession like what they're envisioning would look and feel like when it comes to, for example, the unemployment rate.
So, taking your question, of course, today our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting. So the staff's forecast is, so let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow at a modest rate this year. And I think that's, so different people in the committee have different forecasts. That's my own assessment of the most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa. The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives. So broadly, the forecast was for a mild recession, and by that I would characterize as one in which the rise in unemployment is smaller than has been typical in modern era recessions. I wouldn't want to characterize the staff's forecast for this meeting. We'll leave that to the minutes, but broadly similar to that.
Rachel. Thank you, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I'm wondering if you can talk about the account of possible effects of a debt limit standoff. You've said repeatedly that the ceiling must be raised, but do you see any economics effects of even getting close to a default? And what type of situation would that look like?
So I wouldn't want to speculate specifically, but I will say this. These are fiscal policy matters, for starters, and they're for Congress and the administration, for the elected parts of the government to deal with, and they're really consigned to them. From our standpoint, I would just say this. It's essential that the debt ceiling be raised in a timely way so that the U.S. government can pay all of its bills when they're due. A failure to do that would be unprecedented. We'd be in uncharted territory, and the consequences to the U.S. economy would be highly uncertain and could be quite averse. So I'll just leave it there. We don't give advice to either side. We just would point out that it's very important that this be done. And the other point I'll make about that, though, is that no one should assume that the Fed can protect the economy from the potential, short and long-term effects of a failure to pay our bills on time. It would be so uncertain that it's just as important that we never get to a place where we're actually talking about or even having a situation where the U.S. government's not paying its bills.
And just to follow up, was discussion around the uncertainty of a possible standoff, did that affect today's monetary policy decision at all?
I wouldn't say that it did. It was, of course, it's something that came up. We talk a lot about risks to the outlook, and that come up. A number of people did raise that as a risk to the outlook. I wouldn't say that it was important in today's monetary policy decision yet.
Steve.
Mr. Chairman, thank you. Steve Leisman, CNBC. Can you tell us what the Federal Reserve Board did in the wake of that February presentation where you were informed that Silicon Valley Bank and other banks were experiencing interest rate risks? And can you tell me what supervisory actions you've done in the wake of the recent bank failures to make sure that banks are currently appropriately managing interest rate risk? And kind of part three, but it's all the same question here. Do you still think this separation principle that monetary policy and supervision can be handled with different tools? Thank you.
Sure. So the February 14th presentation, I didn't remember it very well, but now, of course, I've gone back and looked at it very carefully. I did remember it. And what it was a general presentation. It was an informational briefing of the whole board, the entire board. I think all members were there. And it was about interest rate risk in the banks and lots of data. And there was one page on Silicon Valley Bank which talked about, the amount of losses mark-to-market losses they had in their portfolio. There was nothing in it about, that I recall anyway, about the risk of a bank run. So it was, I think the takeaway was they were going away to do an assessment, a horizontal assessment of banks. It wasn't presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of a thing, and I thought it was a good presentation, and as I said, did remember it. In terms of what we're doing, of course, I think banks themselves or many banks are now are attending to liquidity and taking opportunity now, really since the events of early March, to build liquidity. You asked about the separation principle. Like so many things, it's very useful. But ultimately, it has its limits. I mean, I think in this particular case, we have found that the monetary policy tools and the financial stability tools are not in conflict. They're working well together. We've used our financial stability tools to support banks through our lending facilities. And at the same time, we've been able to use our monetary policy tools to foster maximum employment and price stability.
Mr. Chairman, I'm sorry. I don't mean to be argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I mean, I didn't say it wasn't alarming. It was they're pointing out something that they're working on and that they're on the case. That I'm not sure whether they mentioned. I think they did actually. They mentioned that they had taken regulatory action, or supervisory action in the form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank, and there are many other banks that are experiencing these things, and we're on the case.
Go to Victoria.
Hi, Chair Powell. I wanted to ask you, obviously, with the recent bank turmoil, we've seen multiple banks buy other banks, and I was just curious whether you think that further consolidation in the banking sector would increase or decrease financial stability, and whether you have any concerns about the biggest bank in the U.S. Getting even larger.
So, we certainly don't, and I don't have an agenda to further consolidate banks. Consolidation has been a factor in the U.S. banking industry really since interstate banking, and before that even. It goes back more than 30 years. When I was in the government a while back, I think there were 14,000 banks. Now there are 4,000 and change. So that's going on. I personally have long felt that having small, medium, and large-sized banks is a great part of our banking system. The community banks serve particular customers very well. Regional banks serve very important purposes, and the various kinds of GSIBs do as well. So I think it's healthy to have a range of different kinds of banks doing different things. I think that's a positive thing. Is it a financial? So I would just say, in terms of J.P. Morgan buying First Republic, the FDIC really runs the process of closing and selling a closed bank completely. That is their role, so I really don't have a comment on that process. As you know, there's an exception to the deposit cap for a failing bank. So it was legitimate, and I think the FDIC, I believe, is bound by law to take the bid that is the least cost bid. So I would assume that's what they did.
So, but do you have any concerns about
The fact that they're getting larger in general.
So I think it's probably good policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing bank, and I think it's actually a good outcome for the banking system. It also would have been a good outcome for the banking system had one of the regional banks bought this company, and that could have been the outcome. But ultimately, we have to follow the law in our agencies, and the law is it goes to the least cost bid.
Let's go to Colby. Thank you. Colby Smith with the Financial Times. At the March meeting, you mentioned that a tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. So given developments since then, how has your estimate changed?
Yeah, I think I followed that up by saying it's quite impossible to have a precise estimate of the words to that effect. But in principle, that's the idea. When we've been raising interest rates, and that raises the price of credit, and that, in a sense, restricts credit in the economy, working through the price mechanism. And when banks raise their credit standards, that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a kind of clean translation between one and the other, although firms are trying that, and we're trying it. But ultimately, we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving, a sufficiently restrictive stance. But I think conceptually, though, we think that interest rates in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted. But that's what we'll be watching carefully to find out.
Just to quickly follow up, what does it suggest about the scope for the committee to pause rate increases perhaps as early as next month, even if the data remains strong then, if it's having some kind of substitute effect?
This is just something that we have to factor in as we want to find ourselves. So I guess I would say it this way. The assessment of the extent to which additional policy firming may be appropriate is going to be an ongoing one, meeting by meeting, and we're going to be looking at the factors that I mentioned that are listed in the statement, the obvious factors. That's the way we're going to be thinking about it. And that's really all we can do. As I say, it does complicate. We have, a broad understanding of monetary policy. Credit tightening is a different thing. There's a lot of literature on that, but translating it into rate hikes is uncertain. Let's say it adds even further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's happening with lending. There's a lot of data on that, and we'll factor that into our decision making.
Howard Schneider with Reuters. Thank you. So noting that the statement dropped the reference to sufficiently restrictive, I was wondering, given your baseline outlook, whether you feel this current rate of 5 to 5.25% is in fact sufficiently restrictive.
So that's going to be an ongoing assessment. We're going to need data to accumulate on that. Not an assessment that we've made. That would mean we think we've reached that point, and I just think it's not possible to say that with confidence now. But nonetheless, you will know that the summary of economic projections from the March meeting showed that at that point in time that the median participant thought that this was the appropriate level of the ultimate high level of rates. We don't know that. We'll revisit that at the June meeting, and that's we're just going to have to, before we really declare that, I think we're going to have to see data accumulating and make that, as I mentioned, it's an ongoing assessment.
And a follow-up on credit, if I could. Could you give us a sense of what the SLUS survey indicated? It was already, I think 45% of banks were tightening credit as of the last survey. What did this one show, and how did that weigh into your deliberations?
So we're going to release the results of the SLUS on May 8th, in line with our usual time frame. And I would just say that the SLUS is broadly consistent when you see it with how we and others have been thinking about the situation and what we're seeing from other sources. You will have seen the Beige Book and listened to the various earnings calls that indicate that mid-sized banks some of them have been tightening their lending standards. Banking data will show that lending has continued to grow, but the pace has been slowing really since the second half of last year.
Nick Tamaros with Wall Street Journal. Chair Powell, the argument around the end of last year and the beginning of this year to slow down the pace of increases was to give yourself time to study the effects of those moves. After the bank failures in March, as you've discussed, the Fed staff projected a recession starting later this year. So my question is why it was necessary to raise interest rates today, or put differently, if the whole point of slowing down the pace was to see the effects of your moves, and now you've, for the last two meetings, been seeing the effects of those moves. Why did the committee feel it was necessary to keep moving?
Well, the reason is that again, with our monetary policy, we're trying to reach and then stay at for an extended period, a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time. And that's what we're trying to do with our tool. I think slowing down was the right move. I think it's enabled us to see more data, and it will continue to do so. So we really we have to balance. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that.
And just to follow up, what you said in response to Howard's question, you'll need data to accumulate to determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intermeeting cycle? As I mentioned, I would just say that this assessment will be an ongoing one. You can't, with economic data, you can't. You've seen, take inflation from it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down and then come right back up. So I think you're going to want to see that that a few months of data will persuade you that you've got this right, kind of thing. And we have the luxury. We've raised 500 basis points. I think that policy is tight. I think real rates are probably, you can calculate them many different ways, but
One way is to look at the nominal rate and then subtract a reasonable estimate of let's say 1-year inflation, which might be 3%. So you've got 2% real rates. That's meaningfully above what most people would, many people anyway, would assess as the neutral rate. So policy is tight, and you see that in interest sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think you feel like we may not be far off, or possibly even at that level.
Thank you very much, Chair Powell. Edward Lawrence with Fox Business. So if the Federal Reserve gets down to the 3% inflation, as the projections show at the end of this year, or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
Look, I think we're always going to have 2% as our target. We're always going to be focusing on getting there.
But would you be okay with a prolonged 3%?
It's let me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. I mean, that's not a question that's in front of us, and it would depend on so many other things. But ultimately, we're not looking to get to 3% and then drop our tools. We have a goal of getting to 2%. We think it's going to take some time. We don't think it'll be a smooth process. I think we're going to need to stay at this for a while.
How does the other side of the mandate, the job side, once you get to 3%, going from 3 to 2, how does the other side of the mandate balance?
I think they will both matter equally at that point. Right now, you have a labor market that's still extraordinarily tight. You've still got 1.6 job openings, even with the lower job openings number, for every unemployed person. We do see some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment. Wages, you all will have seen the wage number from late last week, and it's whenever it was, and it's a couple percentage points above what would be consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments, but the labor market is very, very strong. Whereas inflation is running high, well above our goal, and right now we need to be focusing on bringing inflation down. Fortunately, we've been able to do that so far without unemployment going up.
Matt.
Hi, Chair Powell. Matthew Boesler with Bloomberg News. So many analysts noted at the time of the March FOMC meeting that at least half of Fed officials' projections did imply or seem to imply that a recession was in their baseline forecast as well, given the strong first quarter GDP tracking estimates. And so I'm just wondering if you could kind of elaborate on, why you're optimistic that a recession can be avoided, given that that's the Fed staff's forecast, possibly also the broader committee's forecast as well, and also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the Summary of Economic Projections and all that. I don't think you can deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number. Anyway, in any case, I'll just say I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand, really, in the labor market. It's interesting, as we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%, pretty much where it was, even lower than where it was when we started. So job openings are still very, very high. We see by surveys and much evidence that conditions are cooling gradually, but it really is different. It wasn't supposed to be possible for job openings to decline by as much as they've declined without unemployment going up. Well, that's what we've seen. So there are no promises in this, but it just seems that to me that it's possible that we can continue to have a cooling in the labor market without having the big increases in unemployment that have gone with many, prior episodes. Now, that would be against history. I fully appreciate that. That would be against the pattern. But I do think that the situation in the labor market with so much excess demand, yet, wages have been moving down. Wage increases have been moving down. And that's a good sign.
down to more sustainable levels. So I think it's still possible. I think the case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is, I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
The committee also noted in March that wage growth was still well above levels that would be consistent with 2% inflation. Do you see that as well? And could you kind of explain, how you come to that judgment?
Sure. So we look at a range of wage measures, and then that's a nominal. And then so you assume wages should be equal to productivity increases plus inflation. And so you can look at the Employment Compensation Index, average hourly earnings, the Atlanta Wage Tracker, compensation per hour, basically those four and many others, and you can look at what they would have to run at over a long period of time for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. Later in an expansion. So, yeah, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that, if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with inflation over a longer period of time. By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that that wages are really the principal driver, because I don't think that's really right.
Great. Chris Rugaber at Associated Press. Well, you mentioned profit margins. Those have did expand sharply during this inflationary period. And while there are some signs that they are starting to decline, many economists note they haven't fallen as much as might be expected, given that we're seeing at least some pullback among consumer spending. So speaking of causes of inflation, do you see expanded profit margins as a driver of higher prices? And if so, would you expect them to narrow soon and contribute to reduced inflation in the coming months?
So higher profits and higher margins are what happens when you have an imbalance between supply and demand. Too much demand, not enough supply. And we've been in a situation in many parts of the economy where supply has been fixed or not flexible enough. And so, the way the market clears is through higher prices. So I think as goods pipelines have gotten, back to normal, so that we don't have the long waits and the shortages and that kind of thing, I think you will see inflation come down, and you'll see corporate margins coming down as a result of a return of full competition, where there's enough supply to meet demand, and then you're really back to full competition. That would be the dynamic I would expect.
Michael McKee from Bloomberg Radio and Television. Can you tell us something about what your policy reaction function is, your policy framework is going forward? When you look at the economy at the next meeting, are you looking at incoming data, which is by definition backward looking? Are you going to be forecasting what you think is going to happen? Are you ruling out the rate cuts that the market has priced in?
I didn't catch the last part. Ruling?
Markets have priced in rate cuts by the end of the year. Do you rule that out?
Okay, I got it. So what are we looking at? I mean, we look at a combination of data and forecasts. Of course, the whole idea is to create a good forecast based on what you see in the data. So we're always looking at both, and it'll be the obvious things. It'll be readings on inflation. It'll be readings on wages, on economic growth, on the labor market, and all of those many things. I think a particular focus for us going now over the past 6-7 weeks now, and going forward, is going to be what's happening with credit tightening. Are small and medium-sized banks tightening credit standards, and is that having an effect on loans, on lending? And so we can begin to assess how that fits in with monetary policy. That'll be an important thing. I just, we'll be looking at everything. It's, again, I would just point out, we've raised rates by 5 percentage points. We are shrinking the balance sheet. And now we have credit conditions tightening, not just in the normal way, but perhaps a little bit more due to what's happened. And we have to factor all of that in and make our assessment of whether our policy stance is sufficiently restrictive. And we have to do that in a world where policy works with long and variable lags. So this is challenging, but we will make our best assessment, and that's what we'll be thinking.
What about the idea of rate cuts?
Yeah, so we on the committee have a view that inflation is going to come down, not so quickly, but it'll take some time. And in that world, if that forecast is broadly right, it would not be appropriate and to cut rates, and we won't cut rates. If you have a different forecast, and markets have been from time to time pricing in quite rapid reductions in inflation, we'd factor that in, but that's not our forecast. And of course, the history of the last 2 years has been very much that inflation moves down. Particularly now, if you look at non-housing services, it really hasn't moved much, and it's quite stable. And so we think we'll have to. Demand will have to weaken a little bit, and labor market conditions may have to soften a bit more to begin to see progress there. And again, in that world, it wouldn't be appropriate for us to cut rates.
Courtney?
Courtney Brown from Axios. I'm curious how you view the role of the overnight reverse repo facility in the context of the current banking stress. Do you think it's contributing to the stress by making it more attractive for money market funds to compete with banks for deposits? And did the committee discuss any changes to the structure of the facility, or do you see that being put on the table in the future? Thanks.
Sure. So we looked at that very carefully, as you would imagine, and it's really not contributing. We don't think now. It hasn't actually been growing. It moved up, it moved down, and then moved back up to where it was. What happened in the when there were the big deposit flows, which by the way have really stabilized now. What happened was institutional investors took their uninsured deposits and put them in government money market funds, which bought paper from the federal home loan banks and things like that. Over the course of maybe the last year, retail investors had been gradually, as they do in every tightening cycle, they've been gradually moving their deposits into higher yielding places such as CDs and other things, including money market funds. So that's a gradual process that is quite natural and happens during a tightening cycle. What was unusual really was the institutional investors moving their uninsured deposits and spreading them around and things like that. But it doesn't seem to have had any effect overall on over the overnight repo facility. That is really there to help us keep rates where they're supposed to be, and it's serving that purpose very well.
Sarah Ewald-Weiss, CBS News. I want to go back to the debt ceiling for a moment. I know you talked about that in terms of fiscal policy, but can you just speak towards what the impact of a default would mean for Americans across the country, the markets, and borrowing?
Yeah, I would just say it's. I don't really think we shouldn't even be talking about a world in which the U.S. doesn't pay its bills. It just shouldn't be a thing. And again, I would just say no one should assume that the Fed can really protect the economy and the financial system and our reputation globally from the damage that such an event might inflict.
Scott.
Thanks, Mr. Chairman. Scott Horsley from NPR. In his report last week, Vice Chair Barr identified a couple of the factors that he thought contributed to the supervisory lapses at Silicon Valley Bank. A policy change in 2019 to exempt all but the biggest banks from strict scrutiny, and also what he called a sort of cultural shift towards less aggressive oversight. You were here in 2019. Do you share that view, and what would it take to get the stronger oversight that you and he said in your release would be necessary?
So I didn't take part in creating the report or doing the work, but I have read it, of course, and I find it persuasive. I mean, I would say it this way. A large bank, not a very large bank, a large bank failed quite suddenly and unexpectedly in a way that threatened to spread contagion into the financial system. I think the only thing that I'm really focused on is to understand what went wrong, what happened, and identify what we need to do to address that. Some of that may just have been technology evolving. You know, we have to keep up with all that, but some of it may be our policies and supervisory and regulatory, whatever. Well, what our job is now is identify those things and implement them, and that's kind of the only thing I care about is. And I feel like I am accountable for doing everything I can to make sure that that happens.
Thank you. Evan Reiser with MNI Market News. Chair Powell, are we in the early stage or nearing the end stage of the banking turmoil among regional banks? And secondly, do you still have a bias to tighten rates? Is that what the statement is saying?
So, I guess I would say it this way. There were three large banks, really, from the very beginning, that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved, and all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period of, is an important step toward drawing a line under that period of severe stress, okay? I also think we are very focused on what's happening with credit availability, particularly, you know, with what you saw in the beige book, and you will see in the sluice is small and medium-sized banks who are feeling that they need to tighten credit standards, build liquidity. What's going to be the macroeconomic effect of that? More broadly, we will continue to very carefully monitor what's going on in the banking system, and we'll factor that assessment into our decisions in an important way going forward.
Thank you, Fed Chairman. Greg Robb from Market Watch. I just wondered if you've done any reflection on your own actions during this crisis and leading up to it over the last, since you've been Fed Chairman. I think I've heard you say a couple of times that you deferred to the Vice Chair for supervision. Do you think that was the right way to go about this? And yeah, comments on that. Thank you.
Sure. So let me say, first of all, I've been chair of the board for 5+ years now, and I fully recognize that we made mistakes. I think we've learned some new things as well, and we need to do better. And as I mentioned, I thought the report was unflinching and appropriately so. I welcome it, and I agree with and will support those recommendations. And I do feel that I'm personally accountable to do what I can to foster measures that will address the problems. So on the Vice Chair for supervision, you know, the place to start is the statutory role, which is quite unusual. The Vice Chair, it says, shall develop policy recommendations for the board regarding supervision and regulation of depository institution companies, and shall oversee the supervision and regulation of such firms. So this is Congress establishing a 4-year term for someone else on the board, not the chair, as Vice Chair for supervision, who really gets to set the agenda for supervision and regulation for the Board of Governors. Congress wanted that person to have political accountability for developing that agenda. So the way it works, the way it has worked in practice for me is I've had a good working relationship. I give my counsel, my input privately, and I offer that, and I have good conversations, and I try to contribute constructively. I respect the authority that Congress has deferred on that person, including working with Vice Chair Barr and his predecessor. And I think that's the way it's supposed to work, and that's appropriate. I believe that's what the law requires. And, you know, but it isn't. I wouldn't say it's a matter of complete deference. It's more. I have a role in presenting my views and discussing, having an intelligent discussion about what's going on and why, and that's my input. But ultimately, that person does get to set the agenda and gets to take things to the Board of Governors, and really in supervision has sole authority over supervision.
I just wondered if you had any regrets, or was there anything that, decisions that maybe you regret now in light of what's happened?
I've had a few. Sure. I mean, who doesn't look back and think that you could have done things differently? But honestly, you don't get to do that. Again, my focus is on control the controllable. As one of my great mentors used to always say, control the controllable. What we control now is make a fair assessment, learn the right lessons, figure out what the fixes are, and implement them. And I think that Vice Chair Barr's report is an excellent first step in that, but we've got to follow through.
Hi there, Megan Casella with Barron's. Did the possibility of pausing at this meeting come up at all, and how seriously was that considered? I'm curious if you can give us any color as to whether there were any initial concerns about raising rates again, or what those discussions entailed.
So support for the 25 basis point rate increase was very strong across the board. I would say there are a number of people, and you'll see this in the minutes. I don't want to try to do the head count in real time, but people did talk about pausing, but not so much at this meeting. There's a sense that we're much closer to the end of this than to the beginning. That, as I mentioned, if you add up all the tightening that's going on through various channels, we feel like we're getting close, or maybe even there. But that, again, that's going to be an ongoing assessment, and we're going to be looking at those factors that we listed and to determine whether there's more to do.
I'm curious, too, how to interpret that and the changes to the statement. Is the bar higher now to raise rates at the next meeting, or would a strong jobs report or inflation print be enough to push the Fed to tighten again?
I don't want to. I couldn't really say. I just think I think we've moved a long way fairly quickly, and I think we can afford to look at the data and make a careful assessment.
Okay, we'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. You mentioned a few times about the lessons you learned from the banking crisis, that you would learn the right lessons. What are those lessons?
Well, I just would start with something that's changed, really, which is the run on Silicon Valley Bank was out of keeping with the speed of runs through history. And that now needs to be reflected in some way in regulation and in supervision. We know now that we know it's possible. I think no one thought that was possible. No one had. I'm not aware of anybody thinking that this could happen quite so quickly. So I think that that will play through. It will be up to Vice Chair Barr to really take the lead in designing the ways to address that. But I think that's one thing. I guess I would just say that then we're going to revisit. It's pretty clear to me anyway. It's clear that we need to strengthen both supervision and regulations for banks of this size, and I'm thinking that we're on track to do that as well.
Can you be any more specific on stress testing or looking at banks that have specific concentrations in certain parts of the economy?
Yeah, that's what Vice Chair Barr's role really is, and he'll take the lead on that.
Okay, thank you.
Thank you.
That does it for the main news conference of the Federal Reserve, with Chairman Jay Powell there following a 25 basis point increase. Looking ahead on the economy, this is what he had to say. His forecast is for modest growth, not a recession. On policy, he was asked, is this a pause? We're getting closer. We're maybe there. We discussed it, but here's the important but. A decision on a pause was not taken today. Are we sufficiently restrictive? That's going to be an ongoing assessment. On cuts, Mike McKee pushing hard on that in the news conference.
See that?
The FOMC's inflation outlook, Tom, doesn't support rate cuts.
The only one in the conference where there was really a stumble, once again,
Always.
was McKee. Always.
If you are just tuning in on TV and radio, this is a special edition of Bloomberg Surveillance, covering the Federal Reserve's latest interest rate increase with Tom Keene, who wants to go home, alongside Lisa Abramowitz. I'm Jonathan Ferro, who is very happy to stay with you. Your equity market on the S&P 500 is negative 0.3%. We roll over and fade just a little bit. In the bond market, yields down by 5 basis points. Keep it together, guys. 391 on a 2-year. Fade just a little bit there too. Bit of dollar weakness in the mix for you. Euro strength, the euro against the dollar, 110.57. If you are just tuning in, welcome to the program. This is what the chairman had to say.
With our monetary policy, we're trying to reach and then stay at for an extended period a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that. This assessment will be an ongoing one.
The chairman of the Federal Reserve said policy was tight. You put credit tightening on top of that, throwing QT. We may not be far off or possibly even at that level when you get closer and closer to being sufficiently restrictive. I think, Tom, the chairman, is struggling to reflect there a consensus on the committee.
Yeah.
Without drowning out that consensus on the committee with his own personal view. You can sense how hesitant he was addressing that question.
And for those of you on radio, there's a time where he looks down and reads the prepared comments, and we saw that 3, 4, 5 times, it seemed, throughout. What I would really emphasize, besides the decline we see, Dow down 200, SPX down 18, is how little the market moved during the press conference. Compared to the last 4, 5, 6 press conferences, I don't think there was the gyrations, the emotion within the conference.
Initially, people, Tom, described it as dovish. Lisa, I have to say, listening to that news conference, that's not my personal assessment of what I heard over the last 50 minutes.
Inflation is a preeminent concern, and that's clear. That said, the market has not shifted in its view that this will be the last cut in this rate hiking cycle that has been the fastest going back to 1981. We just witnessed it according to market pricing, and that from here, the next move will likely be a cut, and it could come as soon as September. And perhaps he had no conviction about pretty much anything, but he did sort of reflect the seesaw underpinning the debates at the Federal Reserve, at the FOMC, that just gave confirmation to markets.
Told you what their new focus was, though, right?
Yeah.
Credit tightening, Tom. It's going to be a big focus for this committee over the next couple of months.
This is the overlay of all these other events that are happening, banking, commercial real estate, et cetera. What does that affect on restrictive? And I've repeated this, I think, twice today. It goes back to Constament Mizuho and this phrase, super restrictive. How restrictive are we now? And some would suggest more restrictive than we imagine, just looking at the data.
I'm just going to put this out there. I suspect that the senior loan officer opinion survey is going to be really boring. And the reason why is because he made it sound that way. He had a written statement when someone asked him, what does it say? And he looks down, he's like, oh, I can't give you any preview, but just to think it's in line. And it's, probably we've seen this tightening since the second half of last year, and it's been ongoing, et cetera. So, but this
you enjoyed the last 50 minutes, I can tell.
I mean, I just was thinking to myself, all these people trying to get him to say something, and he's just like, look, we don't know. And we're doing the best that we can. I think the economy is in better shape than my colleagues. We all agree, though, and yay, kumbaya.
The most important headline from the whole thing, looking ahead, we will take a data-dependent approach to policy.
You predicted this?
We will be data-dependent. We will be data-dependent.
Yeah, sure. Well, let's do this right now. Let us jump to someone who's absolutely been out front on the trajectory of the Fed, and that is William Dudley. He's, yes, a Bloomberg opinion columnist, yes, a former president of the New York Fed, but far more a gentleman of Berkeley, steeped in our economic history. Bill Dudley, I've been dying to ask you this question. This word pause has come up, and the arch question to me, to get to June and on to the rest of what we observe in 2023, if they pause, is it asymmetric or symmetric? Does a pause mean rate cuts to come? Or they can say, we're going to pause and we can go either way. The historians, John Taylor of Stanford, across the pond from your Berkeley, Barry Eichengreen and others, would they say there's a precedent to analyzing asymmetric or symmetric pausing?
Well, I think they can pause and then continue to tighten again if the data turns out to support that. But obviously, when they do pause, they're making a pretty strong statement that they've gotten enough information, that they're confident that policy is sufficiently restrictive, to use Chairman Powell's terms, to bring inflation down to 2% over time. So a pause is going to be a pretty significant event from the Fed. Now, obviously, context matters. If we're in the middle of a debt limit ceiling fight at the time of the June FOMC meeting, we might take a pause for other reasons. But I would say a pause will be pretty important event. What the Fed was trying to do today was say, well, we don't know if we're going to pause or not at this point. The message, I think, in the statement and in the press conference was pretty clear. We think we're getting close to a level that's sufficiently restrictive. We're not absolutely certain. Right. The data is going to tell us that we have to do a little bit more. We're clearly not going to cut yet. So I think the pushback that the Fed is making is really to the market's pricing and rate cuts. The Fed thinks that the process of getting inflation down to 2% is going to take some time, a lot longer than what the market thinks.
I heard one word in the beginning of the comments, and it echoed from Lyle Brainerd. I believe she's at 1600 Pennsylvania this week. And the former vice chair would suggest cumulative. What is the cumulative effect of where we are right now, given how you nailed the need for higher rates to fight inflation?
Well, we're certainly in the vicinity of what's sufficient, I think, in my mind. Whether they have to do another, increase or two, it's hard to say at this point. We've come a long way in the last year. As Chair Powell said in his press conference, you've got 500 basis points, 5% increase in short-term rates. That's a lot in a year. And we're also starting to see some of the effects of that on the banking system, so that the Fed has a whole nother source of restraint, which is credit conditions are going to tighten because some banks are going to pull off. Now, the hard part, as he said in his press conference, it's very hard to assess how important that channel is going to be. My own personal view is it's going to be fairly weak, because the problems that these banks face were not that they went out and made bad loans. The problem that these banks face is they went out and took a lot of interest rate risk.
Bill, were you satisfied with the explanations or the answers to the questions about the supervisory of some of these banking institutions that have failed?
Well, I don't think the Fed has, taken the full responsibility for being pretty slow on this process. I mean, if you go back and look at the November financial stability report, which I did this morning, there's basically no mention of any kind of interest rate risk mismatch, any kind of potential liquidity problem in the bank. So it wasn't just a question of the supervision not being more aggressive with Silicon Valley Bank. I think the Fed basically missed the risk here that deposits could flow out very, very quickly because of the mark-to-market losses on some of these banks' balance sheets.
Do you think then, Bill, they're still missing it, that they don't appreciate the full extent of it based on, for example, the preliminary look that they got of the senior loan officer opinion survey, which seemed to indicate just an ongoing trend of what they had seen? Are they underappreciating a new pressure in the market?
I think that his answer on the senior loan officer survey, it was that it's moving in the same direction that it was upward, the tightening of credit conditions, but not in a way that would suggest that the problems of the banking system since mid-March have led to a significant further tightening of credit conditions. So I think he's basically saying there's not really any new information in the senior loan officer survey. That was my sense of his response to that question.
Dr. Dudley, what you just said is extraordinary. You said basically the Fed missed the ramifications of new digital technology, the speed with which we can move deposits out. A delicate question, if I may, Bill, and that is basically they want Mary Daly's head. There's no other way to put it nicely. You've had experience being a president of a Fed. Do you go after the president of any given regional Fed when there's a major blow-up like this? Or is it much more down the food chain, looking at the process of supervision and regulation?
I think it's a much broader issue about supervisors finding problems with banks and then not forcing the banks to remedy those problems in a timely way. The second issue here was, I think the Fed broadly missed the fact that this interest rate risk that they had created by being very late to tighten monetary policy, that they created by flooding the bank with deposits by doing quantitative easing, that they created part of the stress on the banking system that arose when they had to tighten monetary policy by 5% in a little over a year. So the Federal Reserve has some culpability here, both in terms of the monetary policies that they pursued over the last few years, and also on the supervisory side.
It's certainly culpability they're not really looking to go out and acknowledge in a major way, that's for sure, based on some of the statements we've heard.
They have to a degree. I mean, I thought the Fed report from Michael Barr that came out last week did acknowledge that there was a lot of improvement on the supervisory side that needed to be made. But I don't think the Fed has acknowledged the fact that the monetary policy regime that they followed, which was to be purposefully late in tightening monetary policy, meant you were encouraging banks to take on more interest rate risk. And then those banks got caught when the Federal Reserve had to raise rates by 500 basis points.
Well, that's an assessment your successor at the New York Fed certainly doesn't share, based on his most recent comments. Mike McKee's run out of the news conference to catch up with us. Mike, wonderful questioning to the chairman, as always, in the news conference. Thank you for that on behalf of the whole audience. Really pressing him on those rate cuts, Mike. What was your assessment of what you heard in the last 60 minutes?
Well, I think basically what we heard was the Fed saying we don't know exactly what we're going to do, so we're going to play it carefully, and we will punt on a decision or on forward guidance for now until we get a better read on the economy. Powell was at pains to say his own personal opinion is we're not going to see a recession, but he also ruled out rate cuts in case somebody is thinking that they might do that soon. So a very cautious Fed here. If I could, I'd like to ask Bill Dudley a question if he's still with us about that, because the data don't change a whole lot in 6 weeks. What would be the bar for the Fed, since you've been in those meetings, for the Fed to raise rates, to change its mind, to say we need to do more? What would they need to see?
I think they had to see evidence that the economy isn't slowing, that the labor market's not loosening, that wages aren't coming down, that core inflation's not falling. I mean, at the end of the day, what they're trying to do is assess what is sufficiently restrictive in order to get inflation back down to 2%. Before the banking system problems, they thought sufficiently restrictive was higher than what we are today. In fact, Powell was talking about potentially even doing a 50 basis point rate hike not too long ago. And then the banking problems hit. And so that's caused the Fed to lower their estimate of what sufficiently restrictive is. So the data will inform them about what sufficiently restrictive is. If the data is really strong, they'll revise up their notion of what sufficiently restrictive is.
Well, Bill, are they going to put more weight on financial sector data, or are they going to put more weight on the data coming from traditional indicators?
I think they're going to put a lot of weight on what they're seeing in terms of the labor market, wages, and inflation. That's really where they haven't made much progress yet. They're also going to probably take some signal by what's happening in the housing sector, because if you look at the single-family housing sector, it looks like it's actually stabilizing. So the policy restraint that's already been put in place looks like the effects of that on housing are starting to fade.
Bill, just a final question from us all. This is something Mike McKee's brought up over the last week in my conversations with him, whether this would be a nod to June 2006. You obviously have a deep understanding of the history of the Federal Reserve. Back in June 2006, they wrote in the statement, the extent and timing of any additional firming that may be needed to address these risks will depend on the evolution of the outlook and et cetera, inflation and economic growth implied by incoming information. Now, Bill, do you think it's a deliberate nod to June 2006 when essentially that decision ended up being a pause?
No, I don't think they know yet. I think Powell was being very honest when he said that we haven't made any decision about whether we're going to pause yet. I think they think that the probability is higher that they're going to pause, but they haven't actually got there yet.
Bill, thanks for that. Wonderful to get your perspective. Bill Dudley there on the latest from Bloomberg Opinion, and of course, the former New York Fed president on this Federal Reserve decision. If you are just tuning in, welcome to the program on TV and radio. Special coverage here, Bloomberg Surveillance, after hours, late. Very late. Tom Keene, Lisa Bramis, Jonathan Farrow. After hours at like 3 p.m., which is bedtime.
It's brought to you by LL Bean. We got a pub tent over
the
here.
equity market, negative 0.6% on the S&P. TK in a bond market. We're down 7 basis points now. The 2-year right now, 3.88.
Equities give way. There's no question about it. I've been looking at Apple. We'll get to that tomorrow. But, John, what Dr. Dudley said there is extraordinary. He did not mince any words about this institution missing the effect, the slew, the Newtonian rates of change of the interest rate move. And there hasn't been enough talk about this. You can do it on a Bloomberg terminal. It's in your face. And to hear that from Bill Dudley, I don't care that he's an ex-official. That was a scathing rebuke of his institution.
Failed on regulatory oversight. To some extent, there's been an acknowledgement of that in the most recent report. One. But two, to your point, They increased interest rates aggressively from 0 to 5. They weren't front-loading. They were catching up. And because they had to catch up, you've had this rate shock. And that's what Bill Dudley is talking about.
I know we got to get to Jeff Rosenberg, but basically, folks, this is Bramo and Farrell all wound up, and me and McKee are more institutionally friendly. I'm sorry, some of the people that...
Hey, let me clean up what you just said. What you mean by that, and I'll leave Mike out of it, is that you have the establishment view.
Yeah,
and we're questioning it.
You know, it's like 2020. They put their pants on one leg at a time, like everybody else. But the bottom line is, here's a guy with immense experience. Bill was in my book. Blah blah blah. Great. He was scathing about his institution.
Debt crises always happen in instruments that are thought of as safe. That is always what has happened. Back in 2007, 2008, it was the AAA rated debt that was tied to mortgages that were basically bundled together. So here's the question. Has this Federal Reserve, and frankly regulators more generally, just let me finish, have they basically assumed a complete lack of risk in some of the benchmark treasuries that they're using as like the safety pools, as the buffers? Yeah. And this really, if it's not appreciated, how much further does it potentially go?
You can tell it's getting late. You know, Ramo's slowly losing it with UT Cap.
Pacific West easing into the close. I'm sorry, Pacific West is giving me a 7 down to 6.52. And when you see people like this with this language, it's enough to make, you know, Jeff Rosenberg's going to get his first gray hair.
Jeff's waiting for us. That's why he's aging. Jeff Rosenberg of BlackRock joins us right now. Jeff, you followed all of that, not this, all of that meeting the news conference with Chairman Powell. Jeff, your takeaway, please.
Yeah, I've got 3 key takeaways here. You know, first thing is, when you just look at the totality of this is pretty much on spot on for market expectations. The statement all but basically admits to this is a pause. In the press conference, he tried really hard to not say that, but to say that, and I think it's pretty clear that that's where we're at. Second thing that I took away, I'll call it the new Powell arithmetic as to how he gets to the pause in that policy is sufficiently restrictive. And so what is that new arithmetic? It's the nominal rate minus 3% inflation gets you to a 2% real rate. Add to that credit tightening and add to that QT, and that's how he gets to sufficiently restrictive. And so I think when we look forward, it's really going to be the assessment on this arithmetic towards sufficiently restrictive. First of all, is 3% the right inflation rate to subtract from that nominal rate? If inflation stays high, that real rate isn't as tight as he's implying. Second piece is, and he admitted this, we don't really know the magnitude of this credit tightening. We only know the directionality. And the third piece is, how much is QT really generating sufficient tightening in the real economy remains kind of very unclear. And the third key takeaway here, and he talked about this, and Mike McKee, great question, because you got this out of him. You know, what about rate cuts in the market? And he highlighted that's the difference between the market inflation forecast, which is a very aggressive decline back down to 2%, versus the Fed's forecast, which is for a much more gradual inflation decline. And that's what separates market expectations for Fed cuts from the Fed's reiteration again here that they will hold rates at this level for a long period of time, in contrast to market expectations. So it gets us back to a focus on the inflation data.
Is your sense, Jeff, that we just witnessed the last rate hike in this cycle?
Well, I think we've seen the last rate hike in the consecutive rate hikes. I think there's a pause, and now it's a pause for validation to what I was just describing. Is this really sufficiently restrictive? There was some acknowledgement by the chairman in the data that suggests some uncertainty, that we're not seeing the degree of tightening in the labor market commensurate with a 5% increase in interest rates. We're not yet seeing critical measures of inflation in that services ex housing inflation coming down at a pace consistent with the attainment of a 2% goal. So these are kind of the cautionary tales around, and even the statement in the language says, you know, we're not moving towards cuts next, we're just pausing, but that doesn't mean that the full cycle is ended and we can claim success. That is going to be about the evolution and the data.
Jeff, do you have confidence that the Fed truly does have a handle on what's going on in the regional banks, given what they acknowledge was some pretty significant oversights, and based on what you see in the granular data that you study every single day in order to make trades?
Well, I think, the anatomy of a banking crisis is very hard to assess, whether it's done. He got the question. He was very careful about answering it. I think it's clear that this first phase, when he identified the 3 problematic banks now being under resolution, that putting sort of a line under the first phase, and I think that's the case. We can see that in the data. You can see that in the deposit flows. I think he's very reticent to make too big and too large of a blanket statement on that, given the uncertainties that we associate with banking crises. I think the second thing is really the critical one, and that is not the direction of credit tightening. Yes, this is tightened credit. It's important to note, and he highlighted this in the upcoming SLOOS, as well as in the Beige Book data, we had seen tightening in credit conditions already in place before the March banking crisis. What's unclear here and very hard to measure is what on the margin has this done to accelerate that relative to trends that were already in place for a 500 basis point tightening. And as he admitted, with honesty and humility, very hard to make that assessment. And I think that's the right assessment in terms of the magnitude of the quantity of the credit tightening.
And Jeff, we're seeing the banks roll over here as well. Keith Briette and Woods index moves down to new lows back to 2020. And I also would point PacWest moving over just as one of the banks having a tough afternoon of it. Jeff Rosenberg, the fact is what I'm looking at is a 3-month, 10-year spread. The short T-bill versus the benchmark. It's truly in the cliches uncharted territory. It is out 5.4 fitted standard deviations with a velocity to an ever greater inversion. Which part of that barbell matters? Looking at the 3-month dynamic or looking at the 10-year dynamic?
You're going to hate this answer, Tom, but both matter, and they're telling you different stories, right? The front end is telling you about the extent of where we are in terms of policy, and the tightening that has happened. The long end is telling you about the confidence in the market forecast for inflation to turn right back down to 2%. You can also argue, and I think there's merit to these arguments, that there's some risk premium in there. There's some tail risk scenarios that are reflected in the 10-year. There is the expectation for the Fed to react to those kind of growth shock, tail risk shock by easing monetary policy. And there's a forecast here that inflation goes right back down to 2% pretty aggressively. So I think that's what's the message of that deep inversion. You can also say that that's telling you that you're not going to get that inflation decline without a deeper recession than, say, Powell is forecasting. So all those things are implicit in that amount of curve.
What's important here, Lisa, is we're going to standard deviation analysis. It seems like not every chart, but half the charts I'm looking at, I'm now looking at the size of the move given the trend, which is what you do with standard deviations. And frankly, that's what you do on the edge, in crisis, coming out of crisis. I mean, that's sort of the tone here you get, again, with SPX off 23 points.
And PacWest down 4%, a similar kind of move in Western Alliance shares as we degrade heading into the close. I do wonder, Jeff, your comment on Drew Mattis's point, Drew Mattis of MetLife. He wrote in saying, what a missed opportunity to provide relief to the banks. An unexpected pause could have flushed out shorts in the sector and created more breathing room. What is your view, Jeff? Do you think that this was a missed opportunity to throw a lifeline to some of these spiraling prices that we've seen in the regional banking sector?
He sort of got that question a little bit, when he got the question, why didn't you pause? And he gave an answer that was about getting to sufficiently restrictive. But I think the subtext, which he didn't discuss, but I think it is something that is important, is the potential for creating an overreaction by financial markets, right? So he was very much taking pains to not use the word, leading you basically up to it without saying it. And I think that was pre-scripted, again, to avoid what we had seen in other FOMC press conferences, an overreaction, too large of an easing in financial conditions, right? So remember, the Fed's perspective here is we haven't won the battle on inflation. Inflation is still way too high, 4.6% on core PCE. So they don't want to give the market any reason to ease the financial conditions tightening. And I think the pause and the early pause, and yeah, there's a banking system perspective on that, but there's the broader system perspective, and that the tightening in credit conditions is actually aligned with their inflation objectives. And so they don't want to push too far back against that and create an unintended easing in financial conditions at this point in the inflation fighting, which is not yet won.
You need a PhD in psychology. Jeff Rosenberg at BlackRock. Jeff, thank you, sir.
Yeah, no, that's
thank you very much.
That's accurate.
Talk about surveillance. You're talking about
all of the above.
Game theory.
Your equity market breaking down a little bit here. I've got to say, PacWest is down about 3.8% or so. Western Alliance is negative as well. We're down there by 4%. The equity market breaking down on the S&P by 0.6%. Here's a final line from Thomas Thornton of hedge fund telemetry. No rate cuts for you. Seems to be the takeaway right now. Going into the close, here's some coverage for you. Seema Shah, Chief Global Strategist at Principal Asset Management alongside Scala Fu and Romain Bostic. Looking forward to their conversation. Tomorrow morning on Bloomberg Surveillance, Ben Laidler, Jane Foley, Wei Li. We go from the Federal Reserve to the ECB tomorrow, Apple after the close on Thursday, then on to payrolls. From New York City, thank you for choosing Bloomberg TV and radio. This was Bloomberg Surveillance. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:46 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ very much in the red. 13 minutes to go ahead of the closing bell. This update is brought to you by BNY Mellon. Insight offers world-class speakers, professional development, inspiration, and networking. Learn more at visit insight.bnymellon.com. Stocks retreated after Jay Powell said there will not be any rate cuts if inflation remains too high, while signaling a possible pause in the Federal Reserve's hiking campaign. Here's Powell live at the news conference.
Today, the FOMC raised its policy interest rate by a 0.25 percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
Reaction to the FOMC decision and the news conference from former New York Fed President Bill Dudley, who is also a Bloomberg opinion columnist.
But obviously, when they do pause, they're making a pretty strong statement that they've gotten enough information, that they're confident that policy is sufficiently restrictive, to use Chairman Powell's terms, to bring inflation down to 2% over time. So a pause is going to be a pretty significant event from the Fed.
Today, stocks lower. In fact, we are at the lows of the day right now. 13 minutes to go, and NASDAQ down 56, drop there of 0.5%. The S&P down 28 now at 4,091. That is a drop of 0.6%. Dow Industrials down 250 points now, down by about 0.75%. Again, to underscore, lows of the day right now for U.S. stocks. 10-year yield 3.36%, with a 2-year 3.86%. Spot gold up another $10 at the ounce to 2,027, up 0.5. A further retreat for West Texas Intermediate crude below $69 a barrel, indeed closer to 68 right now. A 4.8% drop in WTI, down $3.44 a barrel, 68.22. Bitcoin 28,351, drop there of 1.2%. So again, we've got the S&P 500 index down 23 points, a decline of 0.6%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
3:49 on Wall Street. This is a special edition of Bloomberg Business Week on this Fed Decision Day. I'm Doug Krisner in the Bloomberg Interactive Broker Studio in New York. Carol Masser is live from the Milken Institute Global Conference in Beverly Hills. We'll be checking in with Carol at the top of the hour. In the meantime, let's get to John Kadunas. He is president and CEO of Calamos Investments. He joins us live from the Milken Institute Global Conference in Beverly Hills. John, thanks for being with us. Glad you could make time to chat with us.
Thanks for having me.
Oh, absolutely. So I want to get your reaction to this, the Fed movement today. As expected, 25 basis point rate hike, and the suggestion now, the implication that the Fed is ready to pause in its tightening. Have we seen enough contraction in credit to keep the economy from going into recession?
Well, we need more data points to say whether we go into recession or not. In my opinion, we've been having a rolling recession. And I call it rolling because last year we saw that we had a couple of consecutive quarters of negative GDP. So we're at the cusp, and we're going to have to wait to see if we fall back into that. But every month, every quarter, we get more data, and that's what Powell and the rest of the governors are looking at.
Is this an opportunity for private credit? One of the things that Fed Chair said today is that the Fed is going to be monitoring credit conditions very tightly. We know the story when it comes to some of the regional banks. Even before the SVB situation, credit was contracting. Is this an opportunity for the private market to step in?
I think it's a huge opportunity for private credit. If you see the evolution, I mean, here at the Milken Conference, we look at the origins of Michael, who started his own asset class, basically, high yield or junk bonds back in the 80s, that gave liquidity and money to mid-sized companies. You see the transformation of Las Vegas. It went into corporate because of the financing of a high yield. And then the big banks were giving money after that, the next couple of decades, till they got over-regulated with Dodd-Frank and whatnot, that pulled the liquidity out of the system instead of into the system, and it went to the smaller banks. And so now we've seen what's happened with the smaller banks. So who's going to replace that? Private credit is ripe to become a huge lender of last resort, if you will. So I think private credit's going to be a very, very, very strong asset class here going forward for the next couple of years.
When you look at opportunities, John, are there industries right now that you really feel represent opportunity to kind of build relationships, provide credit, and to benefit in the long run?
Well, I mean, if you look at just what's been performing this year, it's a little bit of the similar story of a couple years ago where the FANG stocks were doing really well. We look at there's approximately 8 stocks that's providing almost 90% of all the upside this year in the S&P 500. And some of those underlying stocks, of course, are in tech and whatnot. And, you know, a lot of the buzz here in the conference, too, has been AI. And there are a couple of these companies that are heavily invested in AI. So I think that's also another big opportunity in growth.
What is the conversation at Milken when it comes to commercial real estate? I mean, when we talk about the stress that some of these regional banks have been facing, the finger goes right to the property market, particularly office buildings. Is that part of the conversation?
That is part of the conversation. Everybody's looking at all the resets, right, with these loans coming due and at higher rates here. So we'll see how some of these CMBS commercial mortgage-backed securities do that are going to be stressed now, because some people will be able to take the payments of higher rates and others won't, and they'll flush out some of this stuff. So they are anticipating bracing for some fallout here in that market.
So will there be opportunities then in terms of distressed debt for some of these real estate companies?
There's always is, but once again, the landscape has changed too since COVID. So the amount of office space that may have been needed in the past Now it's being transformed into something, different. And so there may not be the same amount, and it's used differently than it has in the past because of a lot of work from home kind of mentality, which at this point we don't know how long that will last. We are starting to see a lot more companies going back full time, but it's not nearly as robust as it was obviously pre-COVID.
You mentioned earlier the conversation at Milken around artificial intelligence. I'm curious. I mean, there's been so much debate when it comes to this technology. We know that companies like Alphabet and Microsoft are already playing. There has been many folks who have raised a lot of concern, and I would place Jeffrey Hinton, who left Google recently. I don't know if you saw the article in the New York Times the other day. He was very, very cautious and advising companies on kind of slowing down the pace of their adoption of this technology. Is that something that concerns you? If you had to put money to work as a credit investor, and you're talking about artificial intelligence, how would you extend credit? What would your criteria be?
Well, the first part of your question, it is concerning. It is concerning where this technology is going. All the good that it does, there's definitely fallout in terms of some of the bad that it may do. There's concerns that there's no question that technology over the years has brought efficiency, but also efficiency has brought the loss of jobs, right? And so you can do so much more with so much less because of the technology, and AI is a form of technology that allows for that. Now, having said that, things have transformed, people have transformed, jobs have transformed, and filled in. There's more jobs in other areas that have taken place. And so as long as there continues to be a transformation with new types of jobs for people to fill, it's not going to be as concerning as it could possibly be.
Well, you mentioned technology. One of the things that I think of relations between the U.S. and China. We know the semiconductor story. How do you view that relationship right now? The geopolitics, is that of concern to you when you're making decisions these days?
I think geopolitics is a huge concern. I think fiscal policy is a huge concern, almost more than monetary policy. I think that some of the moves in fiscal policy has definitely helped and hurt. Unfortunately, as of late, hurt a lot of what's going on with the economy. And so bringing these jobs back home, bringing manufacturing back to the United States, not being dependent on other countries for some of the really important things, whether it be the microchips, whether it be pharmaceuticals. I think it's really important that we incentivize companies to do and manufacture in the United States, so we don't have to be dependent like we are right now. And I think this administration has definitely dropped the ball on that.
John, we'll leave it there. Thanks so much. Great conversation. John Kodunas, he is President, CEO of Calamos Investments, live from the Milken Institute Global Conference. Beyond the Bell starts right now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Carol Master, live from the Milken Institute Global Conference in Beverly Hills. We're counting you down to the close. Just about 2 minutes to go here. Welcome to our audiences across Bloomberg Television, Radio Originals, and those folks streaming on YouTube. There was a lot of green on the screen heading into that Fed decision at 2 p.m. Eastern. A lot of red on the screen now that this decision has been made.
Yeah, and we're still continuing to see worries in terms of some of the regional bank stocks. What I find fascinating, Romaine, we've been
talking so much leading up to this meeting, and after all is said and done, ultimately the Fed is still data dependent. Yes, maybe a hawkish pause, but nonetheless, do they think that they could potentially have to do more? They could.
A hawkish pause. Are you trademarking that? Because I think Jay Powell made it clear they're not pausing.
No.
He said that really wasn't the discussion today, or at least no definitive agreement was made today. But he did make it clear that was on the table for the mid-June meeting.
Well, and pauses were talked about by the Fed members, even though they said not for this meeting in particular. And I do feel like, once again, we got kind of the initial statement, and maybe there was a thinking, okay, a pause more likely. And then once you got into the press conference and Mike's question, a different feel.
Well, it was a different question, and a good question. But here's my question to you, Carol.
Yeah.
What is the case for a pause? Because if you say they're data dependent, I'm looking at ADP data we got this morning, big jobs report this weekend. We've seen other data here. That's not the inflationary, the deflationary environment that he's looking for.
Absolutely, and he also said 2%. That's our inflation target.
Yeah.
Asked about.
I did hear when someone asked him about 3%, and he said, "We ain't dropping the toolkit at 3%. Are you crazy?" He didn't say, "Are you crazy?" But that was what he had in his eye.
And the inflation that he really looks at. You have that kind of mind meld with Jay Powell, apparently.
Carol, I mean, I do think, though, that the market reaction is interesting.
Yeah.
Believe it or not, the market reaction, I do think, was a little more subdued, even though we did erase all of those gains. But the idea here that we've really been in stasis for quite some time, you can see those numbers on your screen right now. I know Scarlett Fu's back in our global headquarters in New York with a better read here on where we stand right now with the closing bell. Scarlett.
Yeah, let's take you through the closing numbers here. We have the S&P 500 losing 0.7%, the Dow coming in off 0.8%, and the Nasdaq losing 0.5%. The Russell 2000, actually the lone gainer here, gaining 0.4%. When you look at the industry performers here in the S&P 500 by 24 industry groups, it's overwhelmingly red. There are 4 sectors that did finish in the green, but by and large, it's due to a couple of individual names. Autos like Tesla and Ford did particularly well. You also have commercial and professional services. This is Verisk Analytics, which provides data to the insurance industry, as the big winner. And then Whirlpool and Garmin helping lift the consumer durables and apparel index, and a couple of biotech names as well. But on the downside, Yum and Starbucks helping drag lower the consumer services companies. Energy companies also losing 1.9% on the drop in oil prices, as well as the banks index losing 1.7%, as you guys were just discussing. All right, let's get to Qualcomm's results. This is the chip maker based in San Diego. Second quarter adjusted EPS of $2.15 matches the average analyst estimate. In terms of revenue for the period, $9.27 billion is better than the expected $9.09 billion. When it comes to its outlook, the third quarter revenue forecast is anywhere from $8.1 billion to $8.9 billion. That is a big miss from the expected $9.25 billion that analysts were forecasting. And so what that indicates is that the smartphone slump will continue to drag on. In terms of adjusted earnings per share for this quarter, Qualcomm sees $1.70 to $1.90. Analysts were looking for $2.20. So while the second quarter numbers look like a beat, the third quarter outlook is where Qualcomm falls short, and you're seeing the stock extend and deepen its losses right now in after-hours trading, losing about 5% right now. Carol and Romain will continue to keep an eye on what's going on with these after-hours stocks. Back to you.
A good reminder, of course, that this market isn't just driven by the macro, Carol. It's also, of course, driven by the micro. Those earnings still coming in. But tied into that, of course, is overall economic conditions, business conditions. We talk about the banking sector, whether there's going to be a retrenchment in lending. Powell came out. Remember, he said, let me start here first, addressing the banking sector. In his words, it's sound, but he also made it clear the FOMC, the policy members, did have a pretty interesting discussion about the risk posed.
No, absolutely, which is really interesting. And I think that kind of mirrors some of the conversations that we've heard here, and certainly from the private credit area or private lending area, that they are seeing an uptick in demand because banks are holding back. Powell talked specifically, talked about credit tightening impact and how that will definitely have an impact on the economy. And I think it just reminds us that we are not sure if we are out of the woods yet when it comes to pressures, but we are definitely seeing the slowdown in lending, right?
Yeah.
And that is going to impact the economy and the slowdown.
Well, it'd be interesting, though, but is that going to be a contraction in lending or just a slowdown in growth? Because he was asked about this. He mentioned the senior loan officer survey, which comes out next week, which presumably they would have a little insight into prior. And he said that growth has slowed, but he also said it's still lending growth is still growing.
He said he didn't think recession, right? Also,
Yes.
in general, but he said he wouldn't necessarily rule it out as well, which I really feel like he's really reminding us that they're going to be looking at the data.
Right.
And I also thought it was interesting that he said he didn't agree with some of the Fed staff in terms of their economic projections.
I thought that was interesting.
Yeah, which
but
is
that's not abnormal, we should point out. We've seen this in the past.
Yeah.
The staff is usually a little bit more aggressive.
But they were the ones that kind of planted the rate cuts, right, early on.
Yes.
And which he quickly kind of smacked down when Mike McKee asked about it.
Right.
Saying, we don't think that that's appropriate considering our inflationary targets.
Right, but then, and it gets back to that dual mandate, which is really 3 mandates, but everyone says dual mandates. But the idea here that is their focus.
Right.
He's been challenged on this so many times. I mean, we talk about coming in today, that letter that was sent out by Senator Warren and a few other Democrat lawmakers basically saying you need to stop this, not necessarily because of the data being dependent, that the idea here that there is economic pain out there that maybe isn't showing up in that data and they need to be mindful of. He said, look, I see the pain. I feel the pain.
Right.
But we got a mandate, and we're going to stick to it.
You know, both of us are talking to John Hope Bryant, which is something that he works with financial literacy and really helping folks get into homes that couldn't otherwise tap into the financial system. He's going to talk about, you know, that's one of his concerns. These higher rates are certainly making it more difficult for individuals, maybe with lower incomes, you know, to get into homes. So he understands the pain. Jay Powell understands the pain, but it doesn't sound like he's going to back off of it, right?
Yeah, doesn't sound like it. I am curious. Let's push ahead a little bit.
Okay.
We have a jobs report on Friday.
Right.
I think next week we get another CPI data. And we still got a long way before we get to that mid-June meeting. Earnings season, I mean, I know we have a couple big names next week, but we're kind of almost through it, at least as far as the big cap names
tomorrow.
here. What's the catalyst for this market?
What is the catalyst for this market? I mean, I think, you know, we're going to get back into another round of Fed speak, right? So how do they manage in terms of some of the data points that come out until that next Fed meeting? That is certainly something that can control what we see in terms of the trade. I think that's some of it. I mean, the sentiment in the market's still expecting rate cuts at this point.
Yeah.
To some extent. We'll see if that changes.
Yeah.
We've seen it over this year go from aggressive expectations about Fed rate increases to all of a sudden talking about rate cuts, which just says to me that things can swing pretty rapidly.
And we should point out, I mean, being here at Milken, which is dominated by a lot of folks in the world of private capital, we know that the reactions we're seeing in the public market's a little bit different from the reaction here. I remember when the statement came out right here, this was a crowded room behind us as everybody was on their lunch break here. Wasn't a lot of reaction.
No.
And when I went up and asked people about it, it was kind of a shoulder shrug. After the press conference, same thing. It's this idea, obviously a lot of folks here have a much longer view, but I've also heard from a lot of folks who are saying, hey, I can live with 5% or 5.25, whatever we're at now right now.
Yeah, I mean, we've had worse, certainly, in this, in this
And that's what they all
economy.
said. A lot of these people in this room, they started their careers during the Volcker era or right out of that era when they were used to double-digit Fed funds rates.
Yeah, exactly. I think of Mike Milken and some of his, you know, folks that he worked with at Drexel. I mean, they have seen a lot of different market cycles, a lot of individuals. The one thing I will say, and I don't know if this has come out, Romain, in your conversations, that a fair amount of the market guests are saying one of the things you need to think about is the lag effect in terms of Fed policy. Jay Powell talked about it today, and certainly the impact that has on slowing things down, maybe causing more of a credit crunch, tightening, you know, things up,
The lag
if you
effects
will.
of Fed policy.
The lag effect of Fed policy. And that
What
was
about the
something-
lagged effects of the banking crisis? Because so much
We're
of the
feeling
focus
it. We're
is
still
the
feeling
rates
it.
going up. Now, some would say that feeds through to the banking crisis, but the crisis isn't over.
I agree with you, and I think we have to be very quick and smart, that we
Yeah.
don't just say, okay, one and done. JP Morgan,
Yeah.
First Republic, look at Western
People did that in
Alliance today.
07. People
Look
did that
at
in early
PacWest.
08.
I know, but
Yeah.
again, folks are saying this isn't 08.
No, it's
Yet.
not. It's not. And no one has said that. But everyone has pointed out that there are parallels there when it comes to that lagged effect. The idea that the first shoe to drop really isn't the one you have to be worried about. It's that second shoe to drop that rattles the market.
What's your net takeaway on the Fed?
My net takeaway is on the Fed is that he has done, Carol Massar,
done.
exactly what he said he set out to do. And I think that he may be serious that a pause is in effect.
I think he's still data dependent. We will see. All right, guys, that's a wrap for Romain and me from the Milken Institute Global Conference. We're, of course, Romain's going to go off to do some things. I'm going to head back to New York, but that'll do it for our cross-platform coverage. Beyond the Bell, we will see you again, same time, same place tomorrow. Not same place, different places.
You're listening to Bloomberg Business Week with Carol Massar and Tim Stenivek on Bloomberg Radio.
4:09 on Wall Street, and a special edition of Bloomberg Business Week Radio on this Fed Decision Day. We'll get back to Carol Massar live at the Milken Institute Global Conference in Beverly Hills. We'll do that after we get this data check from Charlie Pellet. Thank you very much, Doug Krisner. Here's what's going on. The Dow, the S&P, NASDAQ all move lower today. But first, want to bring you up to date on Qualcomm. That stock after hours down now by 3.1%. Qualcomm, of course, the largest maker of smartphone processors, and it gave a disappointing sales and profit forecast for the current period, signaling that demand for mobile handsets will remain sluggish. Again, after hours, we've got shares of Qualcomm down now by 2.9%. Wall Street's excitement about a potential pause in the Fed's aggressive tightening campaign was not enough to keep the stock rally going, with Jay Powell dashing hopes on interest rate cuts for now. S&P was down 28 points today, a drop there of 0.7%. The Dow down 270, a decline of 0.8%. NASDAQ today lower by 55 points for NASDAQ. That was a drop of just about 0.5%. 10-year yield 3.35%. The 2-year 3.86%. Spot gold up $16 the ounce now, almost 17 to 2,033, a gain of 0.8%, and a further retreat for West Texas Intermediate crude, very close now to $68 a barrel. WTI down 4.8%, 68.23. So it did turn out to be a down day today for the Dow, the S&P, and NASDAQ. Reaction to the Fed decision from Torsten Slok, chief economist at Apollo Management.
Well, I think what's really interesting in this statement is the weight on the highly uncertain effects of the banking crisis. And on the other hand, they are very explicitly saying the committee remains highly attentive to inflation risk. So it's still this incredible laser focus on inflation.
And indeed, we saw a couple of high-profile bank stocks declining again today. PacWest Bancorp down by 2%. Shares of Western Alliance down another 4.4%. So again, recapping, Fed Wednesday turned out to be a down day for the Dow, the S&P, and NASDAQ. 10-year yield 3.35%. S&P down 28, drop there of 0.7%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thanks, Charlie. A special edition of Bloomberg Business Week Radio. Let's get back to the Milken Institute Global Conference in Beverly Hills. Carol Massar is there with her special guest.
All right, Doug Krisner, thank you so much. Yes, indeed, everybody. We are finishing up one more day and some more wonderful interviews. Carol Massar here at the Milken Institute Global Conference, and of course, as you know, on YouTube and on our Bloomberg Original streaming service. I have to say, in a special edition of the BW Daily, some reporting by our team, Kat Doherty and Allison McNeely, they noted the glum mood among the financial elite at the Milken Institute. Conference here hasn't been limited to bankers. They talked about the lousy environment for private equity fundraising. But as our next guest will tell you, they were actually putting the finishing touches on a capital raise while at Milken. So we're going to get into it. With us on site here at Milken is one of the co-founders of the private equity firm Red Arts Capital, Nick Antoine, and he joins us. Welcome.
Great to be here. Thanks for having me.
It's great to have you here. I want to get to the capital raise in just a moment, but the stresses that we are seeing in the banking community, the regional banks, what impact are you feeling at all when it comes to, I don't know, your world in general, or people maybe coming to you where they can't get funding elsewhere?
Sure. Well, I think it's stratified between size of business. So our firm focuses on middle market companies. So some of those businesses might be more impacted than others. Fortunately, our portfolio has not been impacted to date.
You haven't seen any impact. Okay, so tell me about this fundraise. You guys just wrapped up fundraising from about $270 million for the debut of your private equity fund. Tell me about it.
Yes.
And it was oversubscribed, right?
Yes, our target was 225. So yeah, we're sector focused on investing in supply chain and logistics, and we believe deeply in sector expertise. So I think that was part of the pitch was. This is the right time to be investing in the supply chain, given all the challenges we saw during COVID.
Because of the onshoring that's going on, somewhat of the, some of the conversations I've had here at Milken, it's not that globalization is dead. It's just moving around. Maybe it's going to be different markets, but there is more onshoring going on.
This is absolutely true. I think you're seeing it across the board, big Fortune 500s and smaller businesses. I think people have learned, even though supply chain challenges have diminished somewhat here in this country, people have learned that there needs to be additions to the supply chain strategy, so there isn't one point of failure in the future.
What kind of companies in particular? I know trucking is among some of the companies that you guys have been involved in. What particularly is coming before you?
Yeah, so we're spending a lot of time looking at warehousing. I think that's a trend, regardless of what's going on in terms of onshoring or nearshoring.
The actual buildings, or
that's correct. Yeah,
all
so
of it.
the businesses that operate within warehousing facilities. We are particularly focused on investing right now in transloading or rail-related services around warehousing, so moving big, heavy, bulky loads. And we're also focused on contract packaging. We have a business called Corgistics that we've invested in. They're a large contract packager focused on consumer brands as well as industrial brands. And we're spending a lot of time in aerospace and defense as well.
What specifically there? I was curious about that.
Yeah, so we like manufacturers of parts and components that go into engines, maintenance repair of those engines. Obviously, commercial airlines were heavily impacted by COVID, but there's a major ramp up. And then unfortunately, because of a lot of the uncertainty globally, there's also a high demand for defense-related aerospace services.
So it's actually the supply chains of the things that are moving things around.
That's correct.
Like you can break it down so many different ways.
Yeah.
What are the valuations on things? I mean, have they come down a bit in terms of when you're,
Well, I think that goes back to the size of businesses, as we discussed before. I also think that there is a bit of a gap or a delta between what the sellers are expecting and what buyers are willing to pay for businesses, and some of that has to do with leverage capacity and what lenders are willing to do.
In favor of the buyers or the sellers?
I think it's sellers' expectations might be a little bit higher than what buyers are willing to pay, and you see that probably more likely in the higher ends of the market than the lower ends of the market.
Right.
But in our space, I think there's plenty of opportunities still, particularly because we're so focused.
Nick, I'm wondering, I mean, I love that you play in the middle market space. I mean, I feel like we often talk about the big, publicly traded companies, but there's so many companies in the middle market space. And it's one of the areas, I think, that we're concerned about not being able to get the financing they need or the funding that they need. Based on the activity that you're seeing and the companies that you're seeing, what does it tell you about the economic outlook?
Yeah, I think it's mixed, right? In some parts of the economy, things are very strong, as we touched on in aerospace and defense. The industries are booming. And others, for instance, in trucking, where we do not have any investments currently, freight rates have been significantly impacted. Now that's, again, off of a kind of an all-time high during COVID. But I think there are some lows, and that does create opportunities for investment, particularly if companies or families are looking to exit or have liquidity challenges.
Because a lot of times they are family-owned businesses,
That's
right?
correct. That's correct.
In that space. Having said that, what are the exits for you guys? What's your time frame of holding? Is it typical private equity, or is it maybe a sell to a company or something much more quickly?
Yeah, so we are a typical private equity firm. I think what perhaps might be a little bit different, I think this is a trend that we're seeing in private equity in general, is it's so hard to find the right business, the right culture, the right people. So when you find that, the idea of having to flip things right away, it can be challenging. So I think part of our thematic-related investment work is to find businesses where we understand what the strategy is to grow a business before we get involved. And so what we tell sellers and families is that if the strategy is to grow over a longer period of time, we can help provide the solutions to do that. If it's really just they're looking for the liquidity and they're looking for stewardship for the business for the future, that's a different strategy as well.
Listen, we only have, unfortunately, 30, 40 seconds. You're Black-owned, private equity firm. Yeah. It's a rarity.
Unfortunately, yes.
I know, it is unfortunate. And these are some things I'm going to talk about with John Hope Bryant in a little bit. But I am curious, does it also maybe help you in the middle market space to some extent, or not necessarily? Does it help you, or is it sometimes?
Well, I think diversity is good for business. It's not just the right thing to do, it's good for business. Diversity of thought is an incredibly powerful competitive advantage. We don't market to our firms that we're Black-owned. We market that we're experts in our space, but it's something that we consider. And for instance, today our firm is about 50% women.
I love that. I saw that.
Which is also a rarity in private equity.
So diversity internally as well.
Yeah, you gotta walk the walk.
Right, and it brings you also diverse thinking, diverse ideas, right, in terms of investments.
That's correct.
Thank you so much. I hope we can stay in touch.
Thank you very much for having me.
Love to hear more as you guys are making investments and where you're going. Logistics is always a fun space in terms of what it tells us. Nick Antoine of Red Arts Capital right here at Milken. Folks, you are listening and watching Bloomberg Business Week. This is
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We do check markets all day long at Bloomberg. Turned out to be a losing day for the Dow, the S&P, NASDAQ, and the NASDAQ 100 index. In fact, we ended at lows of the session with a 28-point drop today for the S&P, down by about 0.7%. Dow Industrials down 270, a decline of 0.8%. NASDAQ down 55, drop there of 0.5%. 10-year yield 3.36%. The 2-year 3.86%. Spot gold up $13 the ounce to 2,030, up 0.7. West Texas Intermediate crude down 4.7%, 68.26 a barrel. Wall Street's excitement about a potential pause in the Fed's aggressive tightening campaign was not enough to keep the stock rally going, with Fed Chair Jay Powell dashing hopes on interest rate cuts for now. At the news conference, Powell was also asked about a recession.
I think, you know, the case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is. I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
Powell's comments carried live on Bloomberg Radio. So again, recapping, a down Fed Wednesday. S&P fell 28 points, down 0.7%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar live at the Milken Institute Global Conference. And I want to get to our guest because every time I speak with him, spend some time with him, he always inspires. He reminds us that it will take work and conscious decisions to bring about a more equality and equitable world. So with us is the chairman and CEO of the nonprofit in financial literacy and economic inclusion, Operation Hope. He's involved in so much to close the gap. He's also vice chair of former President Bush's Council on Financial Literacy. I mean, you've worked with President Obama, a council on financial capability. You've done so much. You have your hands in so much. Financial literacy, you're thinking about, you know, housing, access. What's top of mind as you had, I'm sure, a million conversations here at Milken? And have we gotten better in terms of equity?
We've gotten better. The world's gotten worse.
Well, that doesn't feel good.
Yeah, well, the world's in turmoil now. So it's hard to find stable ground to sit good ideas. We've got more good ideas. We've got more proven ideas. Yesterday, Fast Company announced that we won this World-Changing Ideas Award. In a more stable time, that would have been the news that sort of rang around the world and have been rallying around that. You know, in this environment, you have an active shooter in Atlanta. You've got a bank going bust. You got a stalemate in Washington D.C. on the debt crisis. So there's so many things distracting people. The urgent is crowding out the important.
And yet you are getting stuff done, John.
Yet we're still getting stuff done. I just punch right through it. You know, over and around it, through it, I go to it. And rainbows only follow storms. You cannot have a rainbow without a storm first. I don't mind a good fight. I don't mind having to punch through the rhetoric with substance. I've been doing that my whole life, and we have a lot of substance now. And look, we're here. I'm here talking to you. I'm not being pushed to the. I'm not at the edges of the conversation. I'm often at the center of a conversation.
Right.
That's where I want it to be. That's where the issue needs to be. We're just there in a very chaotic, crazy times. I think that we're sitting in a moment in history right now, Carol. But history does not feel historic when you're sitting in it. It just feels like another day. But I think that what happens between now and 2030, between the pandemic and George Floyd's murder and the attack on our Capitol, which reset everything, and the end of 2030 is what I call the third Reconstruction. And this next 10-year period will decide the quality of life for the next 100 years. So I don't mind being exhausted, worn out from working from can't see in the morning, can't see at night. I think it's relevant. I think it matters, is what I'm saying. What you're doing matters. You cannot have a movement without the media. Dr. King never would have had a movement if it wasn't for the media amplifying his good message. So I think that all this is.
Oh, I appreciate that. I mean, it's not
important.
perfect, and we know that. I want to ask about your partnership that you've had with Fulton Bank. Talk to me a little bit about it. Because I feel like, you know, you and I have talked about this. A lot of folks, there's lots of conversations. You actually take those conversations and put it into action. So tell us about this.
Yeah, PhDs are good, PhDs are better.
PhDs. So
the one thing I love about this, and Fulton won't appreciate the way I'm going to characterize this, but I think it's an important characterization. A relatively small-sized bank in Pennsylvania. Small by banking standards, not small by their standards. It's actually a big bank by their standards. Fulton Bank is this great institution in Pennsylvania doing great work, but they're not a household name. This relatively small market cap bank, based on the banks we hear on TV or in Bloomberg all the time, did $1 billion in mortgage creation for African American, not just minority, not women, not some super group of underserved, just African Americans, $1 billion through Operation Hope in our Hope Insides, proving that you can do well and do good, proving that you can move the needle on 41% of African Americans who own a home, and when 75% of whites own a home. That delta of 30% is the loss of wealth creation, the loss of tax base, the loss of opportunity. So the fact that one bank that is not yet a household name, maybe they will be after this interview, did $1 billion of credible, well underwritten, structured home ownership, tying it to our coaching work at Hope Inside, where we got credit scores up, debt down, savings up, so people could qualify. So did it in a safe and sound basis. We just did the hard work together. $1 billion, that's a real number.
What's interesting is, right, it was for people who qualified, and you talked about getting the credit scores up. I mean, these are people that you guys have worked with, right?
Yes.
Who wanted to be homeowners.
Yes.
And what did they have to do?
Yes.
And you educated them.
Yes.
And then they did the work.
So we're getting the bank out of the no business and back into the yes business by working with, and I want to, again, I commend Fulton Bank and their leadership, their chairman CEO. I commend Wells Fargo. I commend, Wells Fargo has ordered 100 of our Hope Inside locations plus. That's not charity, that's business. Bank of America's ordered 100 plus locations.
This means they're inside the bank.
Inside the bank. We're the only nonprofit in U.S. history allowed to operate inside of a bank branch. Truist wants us to spend half of their bank branches. They have 2,000 branches. You're talking about changing banking itself. But back to this example of Fulton. So we go into the bank branch, and we can do what the banker can't do. We can actually ask the person a direct question. Mrs. Jones, yes? Let's look at your credit report. This looks like a bus accident. And we both have a nice laugh because Mrs. Jones knows that she knows her history. Yeah, I haven't looked at my credit score in a while. Okay, what's that? I don't know, John. That's called an error. Okay, the law states that if the credit bureaus, 3 of them, can't confirm that that's yours, they must remove it. How about we write a letter to the credit bureaus together and challenge them? Yes, we write that letter together. What's banking? A trust business. It's about belief. It's about confidence. Credit comes from the Latin word credito, which is credibility. Capital from the Latin word capitas, knowledge in the head. None of this is about money. It's about how you feel. So we get the letter to the credit bureaus. They can't confirm that it's hers. They remove it within 30 days. Her credit score pops 30 points.
That's real.
So now you go from 590 to 620. Well, what happens to Mrs. Jones' self-esteem? It goes up.
Right.
Her belief in the financial system, her trust, her confidence, her sense of independence. So she's sitting there going, okay, what else can we do? So then we tackle the charge-off on her credit bureau. Well, that is hers. She was divorced 10 years ago. It was a $1,000 phone bill, or it ballooned to $1,000. They chased her, couldn't find her. That was sold to a credit repair agency, a debt collection agency, for 5 cents on the dollar. We know that. It's $50. What do they want? They want 100% profit. They want $100. Ms. Jones, let's call them together. We have Mrs. Jones here. We're looking for her. She's looking for you. We want to pay our debt. We want $100. No, we're going to pay you $200. Why? Because we want your absolute attention to take this off her credit report after she satisfies
You want
it.
them to fix it.
And then when it shows back up on her credit report, because it's been there 10 years, you're gonna write another letter to the credit bureaus and get it off again. They get a 200% profit.
Right.
She got an 80% discount. Fair exchange is no robbery. Her credit score goes up another 20, 30, 40 points. So now she's an example. She's at, let's just say 650, 660. She's now in striking distance of a 680 prime rate mortgage. We work on her budget. We work on a few other things.
Right.
And all of a sudden, she's a shiny penny.
John, I am like, it is amazing what you do. And the thing is, you are all about financial literacy. And I think you and I have talked about it. I wish kids were starting from kindergarten, that they learned about it. You work on it from middle school through college, right?
Now kindergarten, by the way.
We're doing kindergarten.
We're doing kids accounts in kindergarten in Atlanta Public Schools.
I mean, and you're working with employers. I mean, you're making a difference, right? People are really learning about the financial system
So
and understanding how they can make it work for them.
Yeah, so now we've told the major employers, so Doug McMillan, the CEO of Walmart, and I are co-chairing Financial Literacy for All. Our mission is to get 80% of the Fortune 500 to embed financial literacy into their business plan. So this is not public affairs or community affairs. This is serious business.
Right.
We say this is what healthcare was 40 or 50 years ago, financial well-being inside the workplace. So then Delta CEO comes to us and says, this is something relevant to our people. Our folks have said this is important. We'll give invest $1,000 to every one of our workers who go through financial coaching for an emergency savings account. Because 64% of Americans, Carol, don't have $400 for an unplanned event. That affects their ability to focus on the job. Their ability they're stressed out on the job. They're not paying attention.
Right.
So he's like, I want all share of mine.
Right.
I don't want them stressed out. He achieved a year's worth of financial well-being coaching targets in 2 months with this program. So he has 90,000 employees at Delta, and I can't go through an airport now without two things happening. A Delta employee saying, I got my $1,000, or I'm in my coaching sessions right now, thank you. Or the TSA agent screaming out the credit score to me.
But how great is that? Listen, 15 seconds left. Yeah. Final thought to anybody who's listening.
You can be the change we want to see in the world. Figure out how you can help. Call Operation Hope, volunteer, become a member, become a donor, become a partner. This is about making free enterprise work for all of God's children. This is civil rights. This is not about red or blue, politics, or black or white. It's about green, economics, more of it for all. GDP for America, and truly by getting more people in the game.
I love it. Makes so much sense.
Love all you guys. Appreciate you. We want you at our Hope Global Forum, by the way.
All right, John Hope Bryant.
You're special.
You're special. All right, let's get to world and national news. Off to Nancy Lyons. She's in our D.C. newsroom. Hey, Nance, take it away.
Thanks, Carol. Atlanta authorities are looking for a suspect after one person was killed, 4 others injured in a shooting at a medical facility in a commercial part of the city. The suspect has been identified as 24-year-old Dion Patterson. He's still on the loose. Mike Palco tells ABC News he was waiting to see a doctor in the building when nurses started ushering people into a room.
All of a sudden, they'd shut down the whole building. We sat there and waited, so Atlanta's finest actually came and took care of business.
Authorities believe the suspect fled the scene in a carjacked vehicle that has since been recovered. The birth rate in the country has been on a long-term decline. Now there are some clues as to why.
A study in the journal Demography finds more women are getting pregnant when they want to, and the share of pregnancies that are unwanted or happening too soon is falling. Researchers at the Guttmacher Institute also find more women, especially those 35 and older, are getting pregnant later than they expected. A researcher who was not involved in this study tells the New York Times it shows people now have more control over their reproduction, and norms about the ideal time to have children are changing. In Washington, I'm Nathan Hager, Bloomberg Radio.
The Rock and Roll Hall of Fame has announced its class of 2023. There are 13 inductees this year, including Missy Elliott in her first year of eligibility, Sheryl Crow in her first year as a nominee, and Rage Against the Machine on a list that also includes George Michael, Chaka Khan, Willie Nelson, and Soul Train creator Don Cornelius. Nominees who did not make the cut this year include Cyndi Lauper, The White Stripes, Soundgarden, and Warren Zevon. He's been eligible for nearly 30 years. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ all finished in the red. Fed Wednesday today with the S&P down 28, drop there of 0.7%. The Dow down 270, a decline of 0.8%. NASDAQ today down 55, a drop of 0.5%. 10-year yield 3.36% with the 2-year 3.87%. Gold up $11 the ounce to 2,030, up 0.7. And West Texas Intermediate crude oil down 4.7%, 68.27 a barrel. After the bell, we heard from Qualcomm, the largest maker of smartphone processors, and it gave a disappointing sales and profit forecast for the current period. Shares down 2.3%. Also reporting after the bell, Zillow Group. It reported earnings that beat estimates as the company's core business performed better than expected in a depressed U.S. housing market. After hours, Zillow up by 4.5%. Wall Street's excitement about a potential pause in the Fed's aggressive tightening campaign was not enough to keep the stock rally going, with Jay Powell dashing hopes on interest rate cuts for now. At the news conference, which was broadcast live here on Bloomberg Radio, Powell also talked about banks and the economy.
The economy is likely to face further headwinds from tighter credit conditions. Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses.
M&A News, Darden Restaurants, the owner of Olive Garden, is buying Ruth's Hospitality Group, an upscale steakhouse chain of 154 locations, for about $715 million. Shares of Darden down 0.2%. Ruth's up 34%, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar live at the Milken Institute Global Conference. And I want to get right to our next guest. He's the co-founder of the French asset manager, TKO Capital. They've got over $15 billion U.S. in assets under management. We welcome Mathieu Chabron. He is here with us on site. So nice to have you here with us.
Thanks for having me, Carol.
Let's start with the Fed policy. Yeah. We're talking interest rates. I feel like, we really need to talk global interest rates because banks globally are on fighting inflation. How does that impact you in your thinking?
Well, I think the first message is, they're confirming that liquidity will have a cost for longer. And that was not the case, obviously, for the past 10 years. And had we had this discussion a year ago, I think I was saying that we were coming out of the mother of all happy hour, And right now they're telling us effectively the bar might remain closed, for a little bit longer. So get used to it. Get used to it, in the cost of liquidity, in the cost of credit. Maybe we'll touch base on that. But, now, what was maybe a 3% cost of funding,
right,
maybe closer to 8 or 9. And guess what? What we learned at school, when, interest rate goes up, asset prices go down. So it's maybe a bit simplistic, but that's the environment we're in.
But Mathieu, it doesn't mean that deals don't get done and things don't get done and investments don't get done,
Absolutely.
Right? Because it's not as high as it could be, and we've had that in certain environments.
Yeah. So it's about, your underwriting assumptions, your entry price, and I think there's still a little bit of adjustments to be made. I think we went, Carol, from let me rephrase. I think that there is a fine line between comfort and complacency, and I think that's where we are. It was very comfortable to have this whole liquidity, and now we're like, okay, there's less liquidity, but let's pretend still a little bit. And I think we should not pretend. We should readjust.
Right,
so
right. Just do it already, right?
I think so. Yeah, I think so. And I think the private market allow that effectively.
Well, so the value of credit. I know that was something before we got going you were talking about. Talk to us a little bit about that and what that means.
Well, it's
what we need to think about.
Who's providing credit? Banks, capital markets, private markets now. Here in the U.S., we've got the BDCs. In many places of the world, we don't have that. And what are the banks telling us is that they're tightening credit. I won't elaborate on the regional banks situation here, but I can tell you in Europe, the ECB just came out with a report saying that credit conditions are as worse as 2011, which was right after the GFC and the Euro crisis. The capital markets are extremely selective. Not everyone can tap the capital market. If
Right.
you're an S&P company or a CAC 40 or a FTSE, it's okay, but an economy is not just made up of all these companies.
Right.
So
And the backbone is often not.
absolutely. In particular, when it comes to employment and jobs, which is, what, public policies are all focusing on. So I think there is effectively this opportunity for alternative source of capital
Right.
to step into this, what was the cyclical opportunity the past 10 years, I think is becoming a bit more structural.
So, Matthew, when you see where capital flows are going, or who is demanding some of that private capital, where is it?
So,
is it certain industries, or is it just everybody in that kind of smaller space?
no, I think it's a bit of everybody. So who are the asset owners today? Insurance company, globally. They've been operating in a very low interest rate environment. They can't really afford that, so they're deploying capital there. Here in North America, public pension funds, endowments, long-term, asset owners. Family offices, a lot of family offices are shifting, into this asset class because effectively the public market cannot provide the recurring income they may need, like an endowment or a foundation, by the way. So we're seeing all of the above. Obviously, here in North America and in the US, we're much more advanced than in other part of the world. Asia was, Korea, Japan, very well positioned on this market. Europe was lagging, by far. So, even if they move by 5-10%, it's a lot of capital coming in.
Right.
And I think it's a good news to address the liquidity shortage.
Matthew, is enough to kind of keep the global economy, the U.S. economy, the European economy from slowing down too much or hitting a recession, which I feel like we debate constantly?
It's very interesting because very often we oppose recession and inflation in this debate. We like to add the third dimension, which is liquidity. And where does this liquidity come from?
Which is really valuable.
I think it is. I mean, again, going back to the banks saga, the past few weeks, it's a pure, how much are you giving me for the money I gave you? And if I can find better elsewhere, I will go elsewhere.
Right.
What do I get in front of my deposit, with you? And so, coming back to interest rates, once again, that's the environment we're in. Part of the inventory may be a little bit aged or dated, defined as it does not pay what it should pay in this market. So let me allocate to this market. I think it's relatively healthy. I'm not seeing some kind of a systemic risk, around that, but it's healthy because capital flows and liquidity, will have a much higher price than it had for the past 10 years.
And I'm looking at a headline crossing the Bloomberg about PacWest set to weigh strategic options, including a sale. So we continue to see the stress in the U.S. regional banks. What you're saying is here's an option, right? And that will keep potentially liquidity going and flowing.
At least
or available at least.
For the clients of those banks who might not be there. It's great that JP Morgan is taking over, one of those banks, maybe, more banks. But we know that if you are a 10, 20, maybe even 50 million EBITDA business across the US or across Europe, you don't bank with many of these large institutions. So you need alternative. So once again, I think it's relatively healthy.
I would love to ask you, because we have about a minute left here, one of the things that I know that you've been thinking about or are working within is opportunities in sustainability and decarbonization.
Yes.
And I do feel like, Matthew, that there has been a bigger focus on that finally clean technology, it's really happening.
Yeah, because, when we started 5 years ago, it was a nice to have, and today it's a must have. So, there's no debate anymore around that. And yes, you need the return on capital you deploy to that, but there's also the impact embedded, with what we do. And we've been relatively early at Tikeo, 5 years ago. We've been deploying across private equity, credit, asset finance here. And here at
More so than you were doing maybe a year ago?
Oh, yeah. Because, it has become, it's no longer an option. It's no longer an option. Your clients, that's what they're asking. Our client, that's what they're asking us to do. There's no other alternative.
If I had to ask you in 20 seconds, and I am going to because I have 20 seconds, are you more optimistic about the next 12 to 24 months or more cautious?
All right, here's the answer. I'm optimistic because I'm an entrepreneur. I'm relatively pessimistic because I'm a leveraged finance banker by background. And so, we have to put all that together and hopefully we'll be right in the swimming line.
Kind of the French version of Jay Powell, right? Like kind of covering it all. Enjoyed this. Look forward to hopefully catching up with you again in the future. Mathieu Chabron, he is, of course, the co-founder of the French asset manager TKO Capital, joining us here on Bloomberg. PacWest shares in the aftermarket down 31%.
Your company news headlines on Bloomberg Radio.
4:53 on Wall Street. We check markets all day long. Developing story. We brought you the headlines moments ago. Sources say PacWest Bancorp, it's a regional bank teetering following the collapse of three rival lenders, has been weighing a range of strategic options, including a sale. Right now, I'm looking at the stock. It is plunging by 41% after hours. Sources say the Beverly Hills-based bank has been working with a financial advisor and has also been considering a breakup or a capital raise. But again, headline worth reporting, PacWest Bancorp is said to be weighing a range of strategic options after hours. That stock now lower by about 42%. Earnings after the bell, Qualcomm gave a disappointing sales and profit forecast. Zillow Group reported earnings that beat estimates, and Tesla has resumed taking orders for its Model 3 long-range edition. Ford beat first quarter profit estimates, posting a surprisingly strong gain on higher vehicle pricing. Bloomberg Surveillance spoke this morning about the firm's outlook with CFO John Lawler.
Look, I think all of us can agree that it's unclear how the macroeconomic environment is going to unfold through the year. There's lots of puts and takes that we're seeing as we work through the rest of the year. And so with a good, strong Q1, but a lot of road ahead of us this year, a lot of puts and takes on a macroeconomic standpoint, traditionally what hits this industry, we held our guidance.
Ford down 0.1% today, GM down 1.8%, Stellantis down 2.7%. Those are the company stories we're following this hour, and this is Bloomberg.
This is Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
All right, everybody, you are listening and watching Bloomberg Business Week live from the Milken Institute. We're going to get back to some conversations in just a moment. I'm Carol Masser. Let's, though, right now get a check on world and national news. A lot going on in the world. We'll head over to Nancy Lyon. She's in her 99.1 newsroom in the nation's capital. Hey, Nance.
Thanks, Carol. Atlanta is on edge with a gunman on the lam after killing one person, injuring 4 others at a downtown medical facility. Police Chief Darren Shearbaum with details.
Unfortunately, a 39-year-old female has lost her life, and of those that are injured is a 71-year-old female, a 56-year-old female, a 39-year-old female, and then a 25-year-old female.
Chief Shearbaum says the suspect has been identified as 24-year-old Dion Patterson, who is believed to be armed and dangerous. The man suspected of shooting and killing 5 people in Cleveland, Texas, is now in custody after a massive manhunt. Francisco Oropeza is accused of killing his neighbors execution style after they complained about his firing a gun in his yard. Officer Tim Keene is with San Jacinto County Police and says the suspect was found some 20 miles away at a home in a closet under a pile of laundry.
Simple flurry of resistance, but they had a canine dog, from what I understand, and there was no injuries of any kind.
Officer Keene says they believe they found the weapon that was involved in the mass murders. Pharmaceutical company Eli Lilly says it has had encouraging trial results for donanemab, designed to treat early symptomatic Alzheimer's. The drug reportedly slowed progression of the disease by about 35%, with nearly half of study participants showing almost no decline of cognition and function for a year. Robert Egge is Chief Public Policy Officer of the Alzheimer's Foundation.
We have for years pushed for treatments that can actually change the underlying course of the disease. And this phase 3 trial results, they indicate clearly that's what's happening.
Egge is concerned, though, because he says the federal government currently restricts Medicare access to Alzheimer's treatments, and he worries many Americans will not be able to afford this new drug. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm